Hello, this is Fat Cat Trades. I want to show you an investing strategy that I've made for TradingView. It uses high-yield bond credit spreads with Nasdaq 100 price action and technical conditions to determine market macro trends, especially for growth assets. Now, the problem with holding growth assets as an investment is that these portfolios can get destroyed in deep market crashes or long bear markets. But during bull markets, however, they perform exceptionally. This strategy is meant to stay in the market as much as possible to capture those bull markets while exiting before these crashes and bear markets. This strategy is, however, a software tool provided for educational and informational purposes only. This is not financial advice, and past performance does not guarantee future results. Now, this is a chart of Nasdaq 100, and this bottom chart right here is what I use to track the high yield bond credit spreads. And it's basically when the spreads go up, the market risk increases and vice versa. This data goes back to 1997, so there's quite a lot of data available. And that's where we start our backtest. Now the strategy goes long here at the start, and there's some clusters of green triangles over here. It's like a optional scaling signal for like deep buying, and usually below 3 the bond risk is quite sustained, so it's pretty good here. A little bit increase here, but still good. These red paints, they mean that signal is getting closer. Could be near to the signal, but doesn't trigger there. Go up, and now over here we get a close signal. Why? Well, the bond credit spread is increasing, and it is significant enough for the close signal. Now after that we do rally a bit up, but then we go down more. It's just volatile, and the risk is increasing over here, but then it cools down a bit, and the price action is so bullish right here that you just can't ignore it, so it goes long here. The bond spreads are quite stable, going a bit lower. We go up, got some clusters here, well, not really clusters, but just signals there, and this is just the crazy era. We only go up, and then it's enough. Here we go. We get the strategy gets out of the market. Some big drops over there, and that's when we start to roll over totally. And as you can see, the bond credit spreads are very high at this point, and the moving averages are just above the prices, so no reason to enter. Even here, even though we go above 200 moving average, the credit spreads are still very high, so no reason to enter until finally over here we get a long signal. So quite a big drop, and the strategy avoided all of that. Now I switched to QQQ since there are slight differences to NDX, but since NDX goes further back, I used it to see how the .com bubble works here. So as you can see with QQQ, the data is not enough to trigger any signals here, so this is where it starts, And as you can see, the bond credit spread risk is dropping significantly. So there are some deep buying opportunities here, and yeah, there's some market pullback here, but strategy handles that. Until here we can see that the credit spreads are ticking higher quite significantly, so the strategy looks best to exit there. But even though it's going up, the market seems to hold pretty steady, so we go back in the strategy goes back in the long here, and here's a quite big market pullback. It's like, let's see from the top, there's the top, it's like 18%, but yeah, this strategy can handle that. The credit spread didn't tick that much higher, so it didn't sense a danger there. But I can tell you that this strategy uses a soft stop loss of minus 20% from the recent highs of QQQ. So why it's soft stop loss is because it also uses RSI, and RSI has to be over 30 because you don't want to ever sell below 30 because that's when the panic is the highest. So it's usually just the opposite, like the good buying opportunity. So yeah, but moving on. So we are still long until over here 2007 we exit here, and as you know, the housing crisis is nearing, and since the price action is strong here, the strategy enters here, but as you can see, and also it's not only price action, the credit spreads also lowered a bit, so there is enter, but we came down to the 100 moving average and there was exit there, and the credit spread are just going higher and higher. So here's where the market finally starts to break down. The moving averages are going down, and yeah, no reason to enter here. This goes down until here we break above the 200 moving average, and the credit spreads are lowering, so that's where the strategy goes long, and yeah, we get some clusters of deep buying opportunities over here. Slight increases there, but not enough to trigger sell signals. Yeah, and that's where there's an exit signal. There's some kind of like a flash crash there, and yeah, we exit here to be safe. And yeah, it's very volatile, but then we finally resolve that and go long there. And yeah, let's just see, we're long. Yeah, there's a sell, but quickly go back long, and there's actually another one over here and go back long, and then there's a sell signal, and with longer time we go just kind of like chopping around, and yeah, the credit spreads are increasing here, but then they start to drop, so we go long here. And we just go up and up. 2018, there's a exit here. Yeah, we're going higher on credit spreads. And this is a bit longer time to go long here because yeah, the credit spreads didn't drop that fast here, so it was safe to stay out until the price action or so. There is a slight pullback afterwards, but yeah, it's a good dip buying opportunity there for the strategy. And yeah, there's the COVID crash. So as you can see, we are quite high here from the 200 moving average, and we go straight to the 200, bounce off it, and that's where the strategy exits at the bounce above 100 moving average. And yeah, it's a quite big drop, but it V-shapes quickly back up, so that's where we enter back long. Yeah, it's just long. 2022 rate hikes. Yeah, it's a quite longer pullback, but yeah, this is like what, 14, yeah, like 15% down exit, but it's still better entry here after all the downside. And yeah, there's buying opportunities, and this is quite recent, last year. So we dropped below the 200 moving average, stayed there a little while. The credit spread was increasing over here. The strategy looks good, exit here, and yeah, we went down. And I remember that a lot of people were thinking we would crash back down, but yeah, if this strategy was followed, then it singled long here, and it was pretty nice upside from there. And yeah, very recently this was like a longer pullback, and yeah, the credit spreads were increasing, and yeah, kind of sold at after the first bounce, but it quickly got back long because we are quite low on the credit spread risk here. So yeah, the strategy is currently long here. If you wanna find out more about this strategy, I wrote a post. It is in the description, so you can check that out as well. So here are the stats for this back test. So it's total 12 trades, 11 of them are profitable, and yeah, it does beat buy and hold while avoiding those big crashes. So, and the conditions are meant to be logical, so they're not just curve fitted to make the backtest look good. Like, I could make the result look much better than that if I just optimized to curve fit the data. So that's not how it is done. If you want to see how this strategy works on other assets, I am currently giving free access periods, so let me know if you want to join that.